Okay, so if you're maybe exploring the idea,
Yeah.
getting a luxury income stream going, maybe a villa, high-end condo, especially in those really sought-after tropical spots, well, you're looking right at Thai property investment. And today we're really zeroing in on maybe the biggest hurdle, rental income tax for foreign owners.
Right. Yeah, it's definitely a hot area, huge potential, particularly, in that prime residential market. But the tax side, it can get complex,
Yeah.
which is why we're leaning heavily on our main source here, the folks at Ocean Worldwide.
Exactly. Ocean Worldwide, they're specialists, right? Luxury residential real estate. Think Koh Samui. And importantly, Phuket. And just so everyone's clear, it's pronounced Phuket. Heard that one wrong a few times. Not Phuket.
Ha, yeah, Phuket. It's important to get that right.
They've actually been based right in Phuket since way back 2004.
That's right. And their director, Sandra O'Neill, she's helped, literally thousands of families, investors. They really know their stuff. They live and breathe this market.
So they've seen it all. Our mission today, let's try and break down those expert rules from them, make it actionable for you. Let's start right at the beginning then. What's the absolute fundamental requirement if you're a foreign owner and you're making rental income in Thailand? Does it even matter where you live or, where the actual rent money gets paid?
No, fundamentally it doesn't matter. The core legal obligation is pretty non-negotiable. If you own property in Thailand and earn rent from it, you must pay Thai taxes on that income. Period.
So the source principle is key.
Absolutely. The income source is king here. It doesn't matter if you live in London or Sydney, or if the rent gets paid into your bank account back home. If the property generating the income is physically in Thailand, Thai tax law applies. Compliance is mandatory.
Got it. So the income is tied to the Thai soil,
Right.
essentially. Makes sense. Now, you hear a lot about residency rules. How does that fit in?
Right, the famous 180-day rule. That's where things get a bit more nuanced. Basically, if you spend 180 days or more in Thailand within a single calendar year, you become a Thai tax resident.
And what does being a tax resident mean in practice?
It means you're taxed progressively on your worldwide income, everything you earn globally.
Okay, worldwide.
Yeah.
And if you're not there for 180 days, a non-resident.
Then you're generally only taxed on income that's sourced from Thailand.
But wait, if the rental income from, say, my Phuket villa is always Thai-sourced anyway, does becoming a tax resident actually change anything for that specific income?
Ah, good question. Yes, it changes things significantly. Even though the rental income is always Thai-sourced, your residency status dramatically impacts how it's taxed. The rate, the calculation method, it all shifts based on that 180-day threshold.
Okay, that's the critical link. Residency determines the rate structure. So let's get into those mechanics. How exactly is the tax calculated? You mentioned structure earlier.
Mhm.
What are the main ways this plays out?
Yeah, there are essentially three main scenarios, three tax treatments you need to understand for your situation. First, if you're an individual and you are a tax resident, you hit that 180-day mark, you'll pay tax based on progressive rates. These apply to your net income after deductions and can go up to 35%.
Net income progressive up to 35%.
Okay. Scenario two. Second, if you're an individual but you're a non-resident, less than 180 days, you generally face a flat withholding tax rate. Often, this is 15%, and crucially, it's usually applied to your gross rental income.
Gross income. Big difference there. Before deductions.
Exactly. Net versus gross is a key distinction between resident and non-resident individuals.
And the third option.
Third option, holding the property through a Thai company, a corporate structure. In this case, the company pays corporate income tax, or CIT. The rate is typically up to 20%, and it's calculated on the company's net profit.
Okay, let's unpack those rates a bit. That flat 15% on gross for non-residents, it sounds quite appealing compared to potentially 35% on net for residents, especially high earners. Is that why some people carefully manage their days in Thailand?
It can definitely be a major factor, yes. That 15% looks attractive upfront, but remember it's on the gross amount. If your property has really high running costs and maybe significant repairs, management fees, that 15% on the total rent might actually bite harder than a progressive rate applied to your much lower net income after you've deducted all those costs.
Right, need to run the numbers. And that 35% top rate for residents, that only kicks in at pretty high income levels, doesn't it?
Exactly. The 35% bracket is for taxable income over 5 million Thai baht. If your net taxable income is, say, under 300,000 baht, the rate's only 5%, and it's 0% up to 150,000 baht, so it ramps up.
Understood. And the corporate structure, 20% CIT sounds competitive too, but you mentioned it's a strategic choice.
Absolutely. While 20% on net profit looks good, you have to factor in the costs and hassle of setting up and maintaining a Thai company. There are annual compliance requirements, accounting fees, filings, and these costs apply even if the property sits empty for a year and generates no rent.
So it's not just the tax rate, it's the whole administrative overhead.
Precisely. It needs careful consideration based on your long-term plans.
Okay, knowledge is power, especially when it saves you money. How do we reduce that taxable income base? Particularly for residents facing those progressive rates, deductions must be key.
They are crucial. You basically have two paths for deductions. Option one is the easy route, the standard allowance. It's a straight 30% deduction off your gross rental income, no questions asked, no receipts needed.
So collect $1 million baht in rent, automatically deduct 300,000 a baht for tax calculation.
Yep, simple as that. It's meant to cover general wear and tear, minor upkeep. Option two is claiming actual expenses. This is where you track and document everything. If you had a really expensive year, maybe replacing the air conditioner system, major plumbing work, things like that, and your documented costs add up to more than that standard 30%, then you'd want to claim these actual costs instead.
But the catch for option 2 is the paperwork, I assume.
Oh, absolutely. Military-level documentation, as you said earlier. You need proper, legitimate receipts and invoices for everything you claim. Think major repairs, yes, but also things like advertising costs to find tenants, property management company fees, and definitely those common area fees or condo management fees paid to the building's juristic person, the condo association. That's a big one, often overlooked.
So keep everything, scan everything, be ready to prove it if you go the actual expenses route.
Couldn't have said it better myself. Organization is key.
All right, so we know roughly how much tax we might owe and how deductions work. Now the practicalities.
Yeah.
How and when do we actually file and pay? What are the forms?
Okay, there are two main forms you need to know about. First is the annual tax return. That's Form PND 90. This is your yearly summary, reconciling all your income and tax paid for the calendar year. Everyone needs to file this.
PND 90, the annual one. Got it. And the second?
The second is the mid-year tax filing, Form PND 94. This isn't always required for everyone, but it is necessary if you earn significant rental income during the first 6 months of the year. It's basically like paying an estimated tax installment halfway through the year. Helps spread the tax burden and avoids a massive bill at year-end.
Okay, PND 94 for mid-year if applicable. Now, withholding tax, WHT. This sounds like where things can get tricky, especially for foreign landlords.
It's a really critical compliance point, often a trap for the unwary. Withholding tax, or WHT, applies specifically when your tenant is a juristic person, so a registered company renting your property.
Not an individual tenant, only a company tenant.
Correct. If your tenant is a company, Thai law requires them to withhold 5% of the gross rent before they pay you the remaining 95%. And that 5% they withhold. They have to pay it directly to the Thai Revenue Department on your behalf.
Hold on. So the business tenant effectively deducts 5% from my rent payment.
Right.
And then I have to chase them for some kind of proof just so I don't end up paying that 5% again myself later.
Yeah.
That sounds annoying.
It can be an administrative headache, absolutely. But getting that proof, the official withholding tax certificate from the tenant, is non-negotiable. That certificate is your evidence that the 5% was already paid. You then use that certificate as a credit against your total tax liability when you file your annual PND 90.
And without that certificate?
Without it, as far as the Revenue Department's concerned, that 5% was never paid. You'll likely have to pay it again out of your own pocket. It's a costly mistake to make.
Ouch. Okay, vital step. Get the WHT certificate from company tenants. What if the rent is paid offshore directly to my account outside Thailand?
Good point. If the rent payment physically happens outside Thailand, the tenant usually doesn't have that withholding obligation. In that case, the responsibility flips entirely back to you, the landlord, to declare 100% of the income and pay the full tax due in Thailand.
Makes sense. Okay, this covers the Thai side pretty well. But what about the listener's home country? Many people will already be paying tax on this income where they live. How do you avoid getting taxed twice? That's the double taxation nightmare.
Exactly. And that's where double taxation agreements, or DTAs, come into play. They're designed to save the day here. Thailand has signed DTAs with many, many countries around the world. Their whole purpose is to prevent the same income being fully taxed in both jurisdictions.
So the DPA sort of decides who gets priority.
Pretty much. It clarifies which country, Thailand, where the property is, or your home country, where you might reside, has the primary right to tax that specific type of income, in this case, rental income, from immovable property.
And does it usually offer some kind of relief?
Yes, typically. For rental income from property, the DTA usually allows your home country to grant you a tax credit for the taxes you've already paid here in Thailand, so you're not paying the full whack twice.
What's the practical step for someone listening?
You need to look up the specific DTA between Thailand and your country of tax residence. Find the article that deals with income from immovable property or rental income. That will spell out the exact rules.
Definitely worth checking that specific treaty. Now, we should probably touch on penalties. What happens if you don't get this right?
Yeah, ignoring the rules is definitely not advisable. It's risky. Think of simple late filing penalties first. They're almost like an administrative fine, like getting a parking ticket you knew you probably deserved. Annoying, but manageable if caught early. But if taxes remain overdue, interest starts accruing. It's currently charged at 1% per month on the outstanding amount until it's fully settled. That adds up fast.
1% per month is steep.
It is. And if it looks like persistent, deliberate evasion, well, the consequences can become much more severe. We're talking potentially large fines, seizure of assets, and in really extreme cases, even imprisonment. Compliance is just much easier.
Okay, message received. Let's shift slightly to the property itself, specifically thinking about luxury condos in Phuket. Are there unique ownership rules foreigners need to know before they even think about renting?
Yes, definitely. The big one is the foreign ownership quota. This comes from the Thai Condominium Act. It states that foreigners, collectively, can only own up to 49% of the total saleable floor area in any single condominium building.
Only 49% freehold can be foreign-owned. What happens if you want to buy in a popular building where that 49% is already full?
Then freehold ownership isn't an option for a foreign buyer. The common, secure alternative in that case is a leasehold. You'd secure a long-term lease on the unit, typically for 30 years initially.
Only 30 years. Doesn't sound that long-term for an investment.
Well, crucially, these leases are often structured to be extendable, usually for 2 additional 30-year periods, so potentially giving you effective control and occupancy rights for up to 90 years. It's a very standard and accepted structure.
Okay, 30 plus 30 plus 30. That makes more sense. Anything else on the purchase side?
One key piece of paperwork. If you're transferring funds from overseas to buy the property, and the amount is over, I believe it's $20,000 USD, you absolutely must obtain and keep the foreign exchange transfer form, often called a TOR-SAM, TT3. This proves the money came from outside Thailand.
Why is that so important?
It's vital if you eventually sell the property and want to repatriate the funds back out of Thailand easily. That form is your proof of origin for the initial investment capital. And all of this really brings us back to that final overarching strategy for success in managing your rental property investment.
Let me guess. Meticulous records.
You got it. Maintaining accurate, organized financial records is absolutely paramount. Keep digital copies of everything, invoices, receipts, bank transfers, the WHT certificates, everything. And the golden rule, something Sandra O'Neill at Ocean Worldwide always emphasizes. Get professional advice. Always consult a qualified local tax advisor in Thailand.
That initial consultation fee is probably far cheaper than a mistake down the line.
Infinitely cheaper. Tax rules change, interpretations evolve. Local, up-to-date advice is invaluable.
So let's try and wrap this up for you, the listener, the potential investor. What does it all mean? The Thai rental market, especially somewhere like Phuket, is buzzing with opportunity. But unlocking that potential profitably really hinges on understanding and managing these tax obligations up front.
Exactly. The key takeaways are your residency status hitting that 180-day mark or not dictates your tax rate structure. Progressive on net for residents, often a flat 15% on gross for non-residents. Maximize your deductions, choose strategically between that simple 30% standard allowance or documenting your actual expenses if they're higher. And finally, compliance isn't optional. Meticulous record keeping and timely filing of the PND 90 and potentially the PND 94 are essential. Don't forget those WHT certificates from company tenants.
Preparation and proactive management seem to be the name of the game.
Absolutely. If you anticipate the tax structure correctly, you can factor it into your rental pricing and accurately project your real net returns.
Okay, let's end with a final thought for you to chew on, something that builds on this but looks further ahead. The source article from Ocean Worldwide hints at something interesting about using that Thai company structure we mentioned earlier. Apparently, holding the property in a company can offer significant tax advantages when it comes time to sell the property.
That's right. Instead of selling the physical property itself, which can trigger various taxes and fees, you might be able to just sell the shares of the company that owns the property. This can often be a much more tax-efficient exit strategy.
Which raises a really interesting strategic question for the long-term investor, doesn't it? You have to weigh the ongoing annual costs and the administrative burden of running that Thai company structure against the potential future tax savings and maybe a smoother process when you eventually decide to exit the investment. Is the hassle now worth the potential benefit later?
That's the $1 million or perhaps million baht question. It requires careful planning and, again, good professional advice tailored to your specific circumstances and long-term goals.
Definitely something to research further if you're serious about investing in Thai property. Food for thought.